Did you know that Silicon Valley Bank, you know that bank that failed the first week of March 2023, and the federal government had to step in and guarantee the deposits of all the people that put money into it? It is directly correlated to the high interest rates that we're currently seeing in 2023. Why are they connected? What happened? And how can you check and see where we're headed going forward? Let's talk about it. This is going to be a short video because this stuff can get super boring and it can get into the weeds, and you start talking about inversions and curves and things like that, and everybody goes, I'm out. Okay? So I'm going to try to make this as swift as possible. SVB, Silicon Valley Bank, is a bank in California, or was a bank in California, that gave a lot of money to tech startups. And these tech startups, they're risky ventures. So already to begin with, there is a modus operandi that they will absolutely fail a good portion of the time. So as people started looking at the tech sector over the last 6 to 8 months, they're realizing that things are falling significantly. Google lays off all these people. You have these major tech companies that their valuations are coming down significantly and quickly. So there was a great push to pull money out of areas where tech startups might be. So Silicon Valley Bank, which is the number 15 size bank in America, start seeing all these people pulling money out the first week of March, like March 8th and 9th. And so they're trying to cover all these deposits. Well, when they do that, they have to sell off some of their investments to cover the depositors that are pulling money out. They sell off $21 billion worth of securities and bonds and lose $1.8 billion. They can't make the money back to cover the deposits that people are trying to pull out of the bank, and the bank fails. Why did they lose $1.8 billion? The reason that they lost $1.8 billion is because mortgage-backed securities and the bond market dropped, right? So their yield, which you would hope would be like 3.13% on a yield on a bond, becomes 2.3%. And when they sell that off, they're losing 30% of value of what they would want to get out of the yield on that, right? Why did that happen? Why did it come down so far? Well, the federal government has been battling inflation for the last year and a half, 2 years, because of all the money that they printed from COVID. And they've continued to print, by the way. So I do want a little side thing here. When somebody says that they're lowering the deficit, that doesn't mean that they're spending less money than what they're bringing in. The deficit is how much they're borrowing. It's the terminology is there to confuse people that don't really follow these economics, okay? So the debt is how much we owe, which I think the last time I heard was like $21 trillion, if you can even think about that number. And if they say, well, we lowered the deficit by $400 billion, well, congratulations, you're only spending $1.3 trillion more than you're bringing in a year instead of 1.7. I'm saving money. Can you imagine? Can you imagine somebody saying that? Like, yeah, I've got a credit card and I borrowed $1 million on my credit card, but don't worry, this year I'm only borrowing $600,000 on my credit card. No, I'm not paying down the value of what I spent. So the $1 million is still there. But this year, I'm only borrowing $600,000 more instead of $1 million. So instead of being $2 million that I owe, it's only going to be $1.6 million that I owe. That's insane. But that's the federal government. And that's what they're selling you, this bill of goods. Oh, well, we lowered the deficit. Congratulations. You spent less money on what you borrowed. Crazy. Anyway, that's my diatribe. I'm going to be done with that now. But them spending that money, all that money, has caused inflation because the value of the dollar lowers because they're printing more dollars. So if I have an iPhone, right, and they go and make 1 billion iPhones, my iPhone right here is worth less money because there's so many out there. Same thing happens with the US dollar. And if they continue to do this, if they continue to print this money too quickly, they have to overcome that with interest rates to be able to get their money back on what they're borrowing. The federal government has to do that. So the value of your home goes up. That's what happened in 2021, along with an artificial curve of everybody wanting to buy because the interest rates were so low. So it created a glut of buyers. Now we're looking at it and boy, the buying has come down 30%, 26% from where it was year over year. What happened? Well, they raised the interest rates and all these people had already bought. So if you didn't already sell and buy your home, you're probably not going to do it anytime soon. So we have higher interest rates, higher values of homes, and people are over there going, okay, if I wait, the interest rates will come down and these home prices will come down too. The good news is the home prices have leveled off and even dropped some. I don't think, however, given how much inflation has risen, that we're going to see home prices come down very much, guys. At least not much more than they already have. So if you're thinking about it and you're saying, next year these prices are going to be way lower. They could be a little bit lower. I don't think they're going to be significantly lower like some people were hoping back in 2008. The interest rate, however, from everything we're looking at and how much money the federal government is spending, it doesn't look like it's coming down anytime soon, at least not significantly. So if you're looking at purchasing a home in the next 36 months, if you wait 12 months, could it be lower? Yes. Does it look like it's going to be now? I'm not seeing that. If you're looking at what's happening, the federal government just spent a bunch of money buying mortgage-backed securities with this bank. And that made everybody go, oh, okay, so we can lower the interest rates a little bit here because the federal government's getting involved. That's dangerous because that means they're going to put a hold on raising interest rates to try to deal with this. But that just means that time is being pushed out. So the longer they wait for these interest rates to go up, the more they have to go up on the interest rates later. That is the way the market typically works. So SVB failed because interest rates went up, because inflation went up. So if you're thinking about buying and waiting, remember that those interest rates have paused for a second on going up, but they still have to go up to be able to cover the inflation that's continuing to rise. Make a decision based on your personal finances, not on what's happening with SVB Bank, not what's happening with the federal government. How much money are you spending a month renting a home? And could you take that money now and put it into something that's going to actually give you your money back over the next 12 years? 12 years is the number that we want to look at because that's over the course of the entirety of people borrowing money for homes. 12 years almost invariably raises the price of your home and gives you a whole bunch of equity for you to purchase another if you need to. If you're in a situation where you need a larger home, do your finances work for you to buy that next home? That's what matters. And when we buy and sell off of fear, we wait too long and we don't buy quick enough, or we buy too soon and we don't wait long enough. That's what fear does. And so when you're entering the market, here's what Warren Buffett said. When everybody else is selling, I'm looking to buy. When everybody else is buying, I'm looking to sell. Okay? Those last couple of years when everybody was buying homes, you had an opportunity to buy with the interest rate super, super low. And that was the best time to buy. The next best time to buy is when it works for you and you can look at it across years instead of days and months. It's very simple in the stock market, especially. If I buy let's say I buy a stock at $100 and the next day it's worth 98 and the next day it's worth 90 and I go, oh my gosh, I'm so scared, and I sell it. But a year from then it's worth 130, but I sold it at 90 and I lost $10 instead of making 30 because I didn't wait long enough. Investments are about time. And especially when it comes to your home, it's about time. So if you wait a year, that's 1 year less of you getting equity on your home. It's 1 year less of you being where you want to be. Make a decision based on where you are currently and where you want to be 12 years from now. And you will make a better decision when it comes to buying and selling your home. And that is how SVB Bank is connected to interest rates and how you can look at it a little bit better. So one little key tip is look at those 10-year treasury bills. Look at the interest rates and see how the lines are going. If those bonds are coming down on treasury, you can almost guarantee the interest rates are going to go up. All right? I hope that helped you today. Y'all have an incredible one. I look forward to helping you on your next real estate question.